Holy smokes, this could be bad for the market and for your money. So today in Meet Kevin Report 4, we're going to analyze the market and something that kind of scary just happened. I mean, like, really scary. I feel like I almost had a heart attack Thursday morning. Okay, the heart attack was possibly a little unrelated because I think that was a mistake, but maybe it wasn't. Let's analyze exactly what happened there and why this confusion is causing a lot of turmoil in the marketplace right now, this weekend, and why you should be paying attention to what happens over the next week or two. Let's get started with Meet Kevin Report number 4. There was a massive shift in the marketplace Thursday, the day after the Federal Reserve announced they're keeping rates steady. But what happened on Thursday and what happened on Friday are incredible pieces of news that we need to pay attention to, and they're going to open up the door to what we should be doing right now, the different scenarios that could be playing out over the next few years. We're going to look at the likelihood of each of those, and then we're going to decide based on those scenarios, what should we do to stay safe in what's about to happen. We thought the problem in the marketplace was going to be the 10-2. That is the inversion of the yield curve between yields on 10-year Treasury bonds and 2-year Treasury bonds. But we were wrong. Apparently, the indicator that everybody is concerned about now is actually the one that inverted. The 10-2, folks, is fine. We have no inversion of the yield curve on the 10-2, which tends to be a predictor of a recession. But unfortunately, now we have professors and the Federal Reserve of San Francisco chronicling, indicating that it's actually the 10-year yield compared to the 3-month yield on Treasury bonds that is really going to be the indicator of the next recession. But fear not, that inversion did happen on Friday. But we know that after an inversion happens, it has to stay inverted for 3 months before technically, or at least in theory, we'll see a recession within the next 18 to 24 months. So this goes to how much time do we have left? When is the market going to crash? Well, that's what the theory is. We look at people like Harry Dent, who tell us on Robert Kiyosaki's Rich Dad Poor Dad podcast that we have maybe one more bubble left in us. That is, Mr. Dent thinks the bubble is going to balloon one more time before it pops, and that could start ballooning at the end of 2019 and early 2020, which really gets us wondering, do we want to be on that ride? Or is it just going to blow up in our face? What should we do? And how do we handle this new news, this new inversion of the yield curve that maybe matters more than the 10-2? And what does it mean for your investments? So let's give you a little bit of a backstory. In 2016 and 2017, the Federal Reserve finally started talking about tightening monetary policy, which is just sort of a fancy way of saying they want to stop stimulating the economy so much to prevent it from overheating, because we don't want things to bubble up and balloon, and I get that. And I think the marketplace as a whole saw that as reasonable, a slow kind of tightening. Well, when 2018 came around, the Federal Reserve got maybe a little too hawkish. That is, they started raising rates a little crazy fast, and that led to a plummeting in real estate values in the summer of 2018, and towards the end of 2018, the stock market really plummeted about 30%. Now, we've seen rebounds, and we've kind of gotten a little bit more comfortable in the marketplace, but that comfortability in the marketplace has now, just this week, turned into confusion, and I want to talk to you about that story of the heart attack feeling, and really what all of us maybe should start internalizing, at least over the next few weeks. Let's go on a walk and let's talk about this together. So I just told the story of basically what happened from 16, 17 to 18. We've talked about what happened in the marketplace pretty regularly on this channel, but what's so important is understanding the marketplace's expectations. Last year we were expecting the Fed to continue raising rates, so the market pulled back. We saw a pullback in values. Well, this year we expected the Fed to maybe be a little bit more cautious, but we didn't expect the Fed to be as extremely cautious as they have now turned. And that is a turning point that has led to one of our yield curves to inverting. Now, we'll talk a little bit about what that means in just a second, but this is really scary because usually when the Fed says, okay, all right, we're good, we're just gonna wait, we're gonna be patient, let's see what happens in the marketplace. Usually when the Fed does that, everybody rallies. Stocks go up, everything kind of, the market stays jubilant, confidence stays up. Well, unfortunately, that did not happen this week. Instead, what happened this week is the Federal Reserve was so cautious, so almost like worry-filled in their demeanor, which is really just the words on paper, but what they said and their indications for GDP growth of the United States economy, that actually left stocks down for the week and yield curves inverting. Let's talk a little bit about strategy, what you should be thinking about. Let's talk some scenarios as far as what could be happening in the marketplace. Talk 3 different scenarios, and then we'll talk about possible solutions for all 3 of those. This week should have been good news. Mortgage rates went down. The Fed said they weren't going to raise rates, but everybody sees what happened as bad news because it's way too conservative, and now it's scary. Before I get into those scenarios, let me just quickly say why I pretty much almost had a heart attack this week and how it made me feel, and I think that's probably how the entire market feels. So here's the thing. Thursday morning, and this chair is soaking wet. Oh well, too late now. Thursday morning, I woke. This is cold. My butt's freezing. Thursday morning, I woke up, and every morning I look at the Zillow mortgage calculator app because it tracks interest rates. And I knew when I went to wake up Thursday morning that I would expect to see the change in interest rates, and I was expecting to see a plummet because I wanted to lock in a refinance that morning. Well, instead, what I saw was actually that interest rates were up 0.7%, and immediately I had this heart attack. I'm like, oh my gosh, this is it. Like, the market is plummeting because of what the Fed said. It is that unclear what is happening in the marketplace. And now Zillow did seem to correct that later, and I reached out to multiple different lenders to say, like, why did this happen? Why did the Zillow chart say this? And I think I finally got to the bottom of it. The reason the Zillow chart actually showed this massive spike and then this sort of volatility and then this plummet in mortgage rates was because the marketplace was that clueless as to how to react. That is actually the turmoil we saw, and later in the day, yes, rates settled down lower. But what it signaled to me, and obviously that's what we're seeing now in the stock market and the bond market, was that maybe it's time to be a little bit more conservative. Now, being a little bit more conservative sort of harkens back to what we've been saying on this channel for the last, whatever, I don't know, 6-7 months. Pay off high interest rate debt, maybe start collecting cash, and take a little bit less risk in the marketplace, because maybe now's not the time to start getting into flips and short-term private money loans, even though there are a lot of short-term private money lenders offering a lot of money right now. Maybe it's not time to take up on a kind of debt. But, as far as the marketplace, well, it's getting a little crazy out here, to say the least, certainly with uncertainty. There is one thing that I could tell you that is certain right now. The 737 has 2 optional features that you could buy if you want more safety features on your plane. Maybe that's too soon. Okay, let's get back to uncertainty and let's get back to scenarios. So here's the thing. We're going to open up here to 3 possible scenarios that I think are going to happen in the marketplace. Let's start with the worst case scenario. Option 1, oh shit. This is where, literally, we go into a deflationary spiral. That is, rather than having inflation, we suffer from possible deflation. The Federal Reserve cuts rates to 0 or possibly a negative territory. Government debt balloons, and all of a sudden, the entire marketplace moves to a position of hoarding cash because everybody is fearful of making any kind of business investment, any kind of purchases. People start cutting discretionary and household spending, and all of a sudden we basically self-fulfill the worst possible recession that we may have seen since the Great Depression. That is what I'm calling scenario 1, the oh shit scenario. And we'll talk about maybe how to handle scenario 1, 2, 3 after we get through the scenarios, but let's talk a little bit about scenario 2, because scenario 1, not so good. In fact, scenario 1 might lead you to question fiat currency in total. That is, our paper money that's not backed by anything anymore. Is it all just going to disappear like the bears have been saying for years? Now, leading up to scenario 1, if we think scenario 1 is possible, we're actually going to want to take money off the Vegas table and run. So keep that in the back of your mind. If you think scenario 1 is possible, yeah, taking money and running is probably the way to go. But we'll touch a little bit more on where to go shortly. Scenario 2 is, going to go in the direction of scenario 1 without the extremeness. So rather than going going into the deflationary spiral where, people with debt actually get punished, which is the opposite of what happens in the marketplace now. If you have debt and there's inflation, it actually rewards you to have debt and pay it off easier. But anyway, number 2 is we see this sort of new normal of maybe inflation around 0.5% to 1.5%, which is very, very low. But we see growth in the neighborhood of maybe only 1 to 2%, slightly above inflation. We're going to try to think of different scenarios and options as far as what's the best play for option 2 and option 3. It's going to be different for option 1. But option 2 is really just, are we going into this recessionary roller coaster where we're constantly on the brink of recession? And we might think, well, has this ever happened before? Well, it's actually happening right now. In fact, if you look at Europe, we can see exactly this sort of teetering. Are we in recession? Are we not in recession? Are we in recession? Are we not in recession? To where the ECB has negative interest rates, and we're really in a position of, is the European Union ever going to get out of this teeter-totter? Well, maybe that's what's next for the United States as well, and we're just going to be on this teetering roller coaster for the foreseeable future. Option 3 is probably the most optimistic of all scenarios, and it's probably the one that I really want to be true, and that is that we're not going to hit our inflation target of 2%. We'll probably stay around inflation of really 1.5% to 2%, slightly under 2%. We stay there, and we see mild growth. That is, no longer are we going to see this 7 to 12% growth with companies or stocks. We're not going to see the long-run S&P average of 8% growth. We're not going to see the long-run Dow Jones with dividends reinvested average growth of 11%. Nope. Instead, we're just not going to go towards a deflationary option 1. We're not going to go towards a super low growth European Union option number 2. Instead, we're going to bounce around growth of a new normal of 3 to 4%, see a little bit of inflation, but everything will just sort of teeter at slower growth levels. And as we get used to slower growth over the next decade without seeing massive ups and downs, maybe then we settle into an environment where we realize, okay, look, we had a big run coming out of the recession. Now we're just plateauing, and the plateau is just the environment that we need to invest within. Well, that's it for 3 scenarios. Now let's talk about maybe what to do within those 3 scenarios, but only after a commercial break. If you are not yet part of the real estate investing course or the real estate agent course, make sure to join so you can get private mentoring with me at least 4 times per week through our private live streams. At least through 2019, you will have access to me as your private mentor twice to 4 times a week, depending on if you're in one or both of the courses, and you'll get all of my insights, access to me and questions, and all of the course content. So make sure to check out the links below, use coupon code ST.KEVIN, and DM me on Instagram if you have questions. Now, let's talk about what you should be doing in these scenarios. Okay, the part you've been waiting for. What should you do depending on where you hang your hat? That is, where do you believe the market is going to go? Which scenario do you think is going to play out? Do you think option 1, the deflationary spiral, is going to play out? Do you think option 2, the extremely low growth European or Japan in the 90s growth, is going to play out? Or are we just going to adjust to a new normal of, well, more hopefully normal growth in the United States over the next 10 years as we plateau? Well, please let me know in the comments which option you think and what safety measures you would be taking for various different options. Option number 1 for deflationary spiral, I would highly suggest finding a safe harbor asset, which might be gold, although there are some people that think gold is also going to get punished and slapped. Maybe you think it's Bitcoin, or maybe you think it's cash. That is, hoarding some sort of asset that would be good in a deflationary time. And usually assets that are based in savings do well during deflationary times because you are rewarded to save and you're not rewarded to have debt. In fact, you get punished if you have debt. So low debt, high savings would probably be a great strategy if you think option 1 is going to play out. Option 2 or 3 are, to me, somewhat going to be based in a similar strategy because both of them are going to have some inflation and both of them are going to have some growth. Neither of them are going to have extreme growth. You'd probably want to do what we always recommend. That is getting discount deals on stocks and companies, or by wedging real estate and understanding the 3 different ways to wedge real estate through what I call the core method of wedging real estate, or by pulling off the Warren Buffett or Charlie Munger cigar butt method and finding deals on stocks. and insulating yourself by buying good discount deals and only buying when you can find things at a discount, never overpaying. Learning how to do that will protect you in option 2 and 3, no matter how much the roller coaster goes up and down. Now that I didn't have a heart attack, I would just appreciate, because the fact that I almost did, and you listened to me for all this time, you press that little red button and you join the pre-100K crowd. Thanks for watching, everybody. We'll see you around. What's up, man?
Not much.
Yeah? I'm a boss. Who are you?
I'm Giovanni.
Oh, nice to meet you, Giovanni.
Nice to meet you too.
Yeah, thanks. And towards the end of 2018, and I think that,
But, you know.